So you think there's a real estate crash coming, huh? Think again. We'll cover the whys and hows of that statement and more coming up next. Well, hello and welcome to Finance Today, your golden pocket for all financial facts and trends. Whether you're into real estate, commodities, stocks, the debt market, or crypto, we cover it all here with some alpha that the mainstream media doesn't want you to know. Quick disclaimer, I'm not a financial advisor and this is not financial advice. This is for your entertainment while hopefully adding some value. So if you're new to the channel, be sure to click that like and subscribe button and turn on those bell notifications so you get updated with all of our latest content. With that said, let's begin. So if you were thinking that residential real estate was in a bubble and 2024 was the year that prices would finally start coming down, I have some data here that may surprise you. Let's take a look at the numbers of the last 4 years and compare them to now to see where we're heading. First and foremost, I want to say that I researched several different sources, including the Federal Reserve's own data, Redfin, Zillow, MLS, Century 21, Remax, and realestate.com. And what I found was that none of the information matched up. Every company seemed to have different numbers, which is super curious in and to itself. So for the purpose of this video, I primarily pulled information from Redfin, a reputable industry real estate brokerage firm, the Federal Reserve, Fannie Mae, and Realtor magazine. The biggest tailwind that the real estate market faces is the Federal Reserve being forced to pivot and cut rates at some point in 2024. I'm expecting that to happen at some point in the summer, which is the height of when most people want to go house shopping, but maybe it happens in Q3, maybe it's mid Q3, maybe it's early Q4. No one really knows for sure, but it's definitely going to happen. You see, fixed debt is an asset because over time, inflation erodes our purchasing power, and knowing how much we have to pay back without the burden of a payment rising with inflation is as good as gold. In 2024, the average person needs to earn $114,627 to afford a home, up 15% from just 1 year ago and up 50% from the start of the pandemic. As you can see, your purchasing power dropped off a cliff from the dollar's inception to only the year 2020. And it's only been getting worse because inflation has only been getting worse, not better, despite what the White House would have you believe. People see homes not only as a place to live, but as a store of value and even a vehicle of wealth creation. That sentiment is absolutely correct, but slightly misguided. Because a home can and historically will increase in value and add to your borrowing potential, but after unplanned rising expenses such as home insurance, home repairs, maintenance, and property taxes, that value can offer diminishing returns unless you're earning cash on your asset. Someone living paycheck to paycheck may find it more difficult than someone who's well off. According to Robert Kiyosaki, your house is really only an asset if it's producing a cash flow for you, not if it's just a place to live in. Then it becomes a liability. But regardless, everyone needs and wants a place to hang their hat and call home, and real estate has been one of the best investments in modern day history and beyond. Historically, purchasing real estate has been a wise investment 100% of the time, given a reasonable time horizon, and the prices are appreciating now faster than ever. Whew! As we always do and always will do, let's look at the most important data when purchasing an asset: the debt market. In December of 2020, the Fed funds rate was at 0.09%, basically zero, and the benchmark treasury rate, the 10-year treasury yield, was at 0.926%, and the 30-year mortgage rate for a conventional loan was at 2.7%. Those are some seriously historically low rates and a product of the ZIRP era. So how do these numbers correlate to one another? The 30-year mortgage rate derives its percentage based off of the 10-year treasury yield, and bond investors set the rate of the 10-year based off of the Fed funds rate. Currently, the Fed funds rate is 5.33%, the 10-year is 4.308%, and the 30-year mortgage rate is near 7%. That's a massive increase and a wildly volatile swing. Let's take a look at what that did to the housing market during that time. According to Redfin, the median sales price of a single-family home was $312,227 at the start of the lockdowns in April 2020 and peaked up to $455,010 in May of 2022. That's a 45.7% increase, or a difference of $142,783. Crazy. Absolutely crazy. We're talking about houses here, not tech stocks. It's not supposed to increase so rapidly, but in this inflationary environment, people want the store of value, especially if it's a scarce asset like waterfront property or farmland. As of February 2024, the current median sales price sits at $427,692, which is a decrease of 6.38% from the peak, but still 36.9% above the April 2020 dollar amount. These prices are correlated with the fluctuating 30-year fixed mortgage rates, which bottomed at 2.7% in early 2020. And soared to a peak of 7.6% in October of 2023. It may not seem like a lot, but that's nearly a 300% increase. The existing home inventory went from 941,733 homes in April of 2020 down to 354,016 homes in March of 2022, and now down to 664,716 in February of 2024. And if you look at this chart, we're still trending down and seeing historically low inventory. This is due to the interest rates plummeting so historically low and soaring back up to higher levels. It's common sense. Folks don't want to sell their homes with their lower fixed mortgage rates to purchase a more expensive home at double or even triple their rate. It seems pretty logical to me. How about you? The rising mortgage rates force people to stay put, and you can see a series of lower highs and lower lows ranging over that 4-year period. The same thing is happening with homes sold above list price. We've seen negative growth from the peak in May in 2022, with 60.4% of single-family homes being sold above list price, to a low of 21.3% in January of 2023. But today that number has increased to 26.1%, setting yet another higher low and once more indicating a reversal pattern. So with this lower inventory, it skews the supply and demand dynamic in favor of the sellers, which will make the sellers be able to set higher prices and have a similar bidding war to what we've seen in 2021 and 2022. Fannie Mae sees home price growth rising 2.4% in 2024 and 2.7% in 2025. The National Association of Realtors only sees the growth rate of 1.4% in 2024, but that's a load of crap, which leads me to my next point, which I believe is yet another huge tailwind for home prices. Let's talk about the National Association of Realtors, better known as the NAR. After being accused of commissions conspiracy, the NAR agreed to a $418 million settlement that avoided the organization to admitting to any wrongdoing. The settlement bans the NAR from setting the relationship between buyer and seller agents, making sellers compensate for the buyer's agent. The NAR wouldn't admit to this, but the norm had been that realtors get 5 to 6% commissions at closing. Now, on MLS, or Multiple Listing Service, which is the main website for registered agents, all fields that show broker compensation have to be wiped out, and there's a ban on requirements that agents subscribe to MLS to get their commissions. What this means for buyers and sellers is that now you have unprecedented leverage to negotiate with realtors to lower their commissions, which ultimately will create a freer market and a much more competitive atmosphere. Unfortunately, these people are in sales, and they make their living based on commissions. So if their commission rate is lower, it stands to reason that home prices will go higher so that these realtors can make the same money that they're accustomed to making. That's my take on this, but let me know what you think in the comments. So you may ask, well, if existing home inventory is still dropping off of a cliff, then why don't they just build new ones? That's a good point, but if you're a buyer, you're not really going to like the answer. According to the Federal Reserve's own data, a newly built single-family home cost $322,600 in Q2 of 2020, up to a peak of $479,500 in Q4 of 2022, down to $417,700 in Q4 of 2023. That is less, not more, affordable than the average existing home for sale. Not to mention, new home market share was 12.3% in 2023, and now it's 13.9% in 2024, showing these more expensive homes are taking a greater share of the overall market. Lumber and copper prices are down from their pandemic highs, but we have two more reversal patterns here in the charts, indicating that these new home prices could and should keep rising. So as they take a greater share of the market and the cost of the building materials continue to rise, the average sale prices will reflect that. It's simple math. Although supply is a challenge across the US, some locations are moving faster than others in authorizing new construction. Fast-growing states in the Mountain West like Utah, Idaho, and Colorado, along with Sunbelt destinations like Texas and Florida, lead the US in the rate of new housing development. On top of that, a whole new wave of first-time homebuyers are set to enter the market, adding more demand to a steadily decreasing supply of homes. And guess where they're moving to? You guessed it, the Sunbelt. The largest outflows of people are coming from New York City, Los Angeles, California, San Francisco, California, Seattle, Washington, Washington, D.C., Chicago, Illinois, and Philadelphia, Pennsylvania. The largest inflows are going into Phoenix, Arizona, Las Vegas, Nevada, Sarasota, Florida, Cape Coral, Florida, Orlando, Florida, and Myrtle Beach, South Carolina. It seems like there's a pattern there, huh? People are leaving blue states for a freer, more tax-friendly red state with better weather to boot. Now, why is this important to mention? Because asset management companies are taking notice. Blackstone in particular has taken notice and purchased Tricon Residential in January of 2024 with a $3.5 billion deal to take the company private. And they really wanted this deal. Blackstone purchased all of the New York Stock Exchange TCN stock at $11.25 per share, which was a whopping 30% over asking price. Why? Well, Tricon was the owner and operator of a growing portfolio of 38,000 single-family rental homes located primarily in, you guessed it, the Sunbelt. That whole World Economic Forum own nothing and be happy line is really starting to make sense now, huh? With asset managers owning more single-family homes, this will shrink the supply more and cause home buyers to have to pay up yet again. On top of that, President Biden is proposing a $10,000 tax credit for all new home buyers, which ultimately will make the market that much more competitive since home buyers will be having that little bit of extra purchasing power. Because, giving away free money isn't inflationary at all, and it always works out every time the government gives handouts. So to sum it up, existing home inventory is continuing to decline, homes being sold over asking price are beginning to climb, mortgage rates are set to decrease where Fannie Mae expects to see a 30-year mortgage rate down to 5.7% before the year's end, new homes are taking a larger share of the housing market, but at a premium. Blackstone wants to own as many homes as possible in the most desirable locations, only to rent them right back to you, which will lower the overall buying inventory. President Biden wants to give every first-time home buyer $10,000 to purchase a home. Home affordability is at a nearly all-time low, and real estate agents are going to do everything they can to keep the money in their pocket that they're accustomed to making, since they can no longer count on their guaranteed 5 to 6% commissions. That's a lot of tailwind for a home seller. Even though I truly believe that residential real estate is in the overvalued phase of its asset cycle, it doesn't really seem to matter now. Maybe overvalued is being viewed as fairly valued in this new hyper-debt-based inflationary world that we find ourselves in. The best plan of attack I see is to purchase undervalued assets that will appreciate over time to offset the absolute massacre of your purchasing power. In an inflationary environment, those tend to be dividend-paying stocks, commodities, gold, silver, cash flow businesses, and my personal favorite, Bitcoin. I made a video about the best chance to grow your wealth in 2024. Link in the description below. Take a look at that if you haven't yet, because I think it'll add some value and some context to this whole loss of purchasing power Ponzi scheme we're talking about. If not, Americans are going to need to simply find a way to earn more money. The wealth gap has increased so much, the middle class has been eroded, the consumer is finished, and we're left with nothing but the haves and the have-nots. You have to take action. You have to do everything you can to be on the right side of this wealth transfer. If not for yourself, do it for your future generations. And you can. You can be in the right spots. Have a mentality of success. Don't give up. The human spirit is a powerful thing, and ingenuity is in our blood. It's time to take action, and you know what to do. It seems like the options are, if you're able to afford it, either purchase a home now with the higher interest rates, or wait until interest rates get a bit lower, but then potentially deal with the bidding war. Either way, the prices will still be high, but remember, if you're comfortable with the payment, real estate has been the choice asset for a store of value and cash flow for millions of investors around the globe, and always will be. Is real estate in the overvalued stage of its asset cycle? Probably. but so is steak, wheat, stocks, juice, and used cars, meaning there's no clear top because the dollar has no clear bottom. It's up to you to do what you want with those dollars while you still have the chance. With that said, I hope you found value in this video, and if you did, click that like button and share the video with a friend. Maybe drop a comment and let me know what you thought added value or what you'd like to hear about in the next video. If you didn't like the video, let me know why and how I can make the next one better for you. Thanks for sticking by until the end. God bless you all. I really appreciate you supporting the channel. And remember, regardless of how your investments turn out, don't get too low, don't get too high, keep it calm, and keep it fi. See you next time.